Welcome back to one of our federal budget wrap-ups. So last night the budget was handed down and we had our traditional budget party, which was a lot of fun. What happened, Alan?
Well, it's basically an election promised by the Liberal government that if they get re-elected, they're going to spend big and give away to as many Australians as possible.
And what's likely to happen? In terms of small business and in terms of everything that we actually cover today, if the Liberal government isn't elected, do you think a lot of these things will end up getting passed?
Bill Shorten's already said this morning that all of the tax cuts for individuals will come in, and he's agreed that there will be still instant asset write-off for small business. But what he hasn't made comment on yet is the big ticket items for retirees around franking credits and looking at capital gains tax as well.
So we're going to cover the things that were actually discussed last night, but obviously none of these have passed legislation yet and will be dependent on who actually gets elected and what ends up happening. So let's start with small businesses. Certainly the hot topic or the thing most talked about for small businesses is the instant asset write-off. So what happens with this if you buy an asset, so think a cheap car, a toolbox, point of sale system, anything that's an asset to your business. Currently, if it's under $20,000, then you're able to write that off immediately. On the 29th of January, there was a bill put forward that said this should be increased to $25,000. And last night, just to make matters even more confusing for small businesses, that threshold is now going to increase to $30,000. So from the 1st of July 2018 to the 28th of January 2019, if you purchased an asset and the cost was less than $20,000, you're able to claim that as an immediate tax deduction.
That's right.
From the 29th of January to the 2nd of April, 7:30 p.m. to be exact, you'll be able to write off anything immediately that's under $25,000, and from 7:30 p.m. on the 2nd of April to the 30th of June, you'll be able to write off anything that is costing $30,000 or less.
Yeah.
Now, the big note here is this is not money back from the government. Nope. It is a tax deduction.
That's right.
So A, you need to be making profit to actually get this tax deduction in the first instance, and B, you actually need to be able to afford this. There's one other point of note. So for small businesses, you're actually able to pull anything that costs more than these thresholds, so the 20, the 25 or the 30. And what that means is you can write off at 15% of the total cost in the first year and 30% of the remaining balance each year thereafter, rather than needing to go through every single asset that you purchase and work out the effective life and therefore write it off over that amount. But again, this is a tax deduction only and certainly not a handout from the government.
It's a good idea if your business is profitable, if you can afford it, and most importantly, if you actually need it.
Correct. It's always if you need it, because you need to spend the cash in order to be able to get this deduction.
That's right.
So the second thing, and probably something that I was excited about for once, is the apprenticeship payments. That's my terminology, so part of the education scheme. And the government is planning on helping 80,000 additional apprentices through their apprenticeship, with the majority of those funds going to small businesses.
That's great.
So there's catches, obviously. So employers are set to get $1,500 at the commencement of an apprenticeship,
Yep.
$2,000 at the end of 12 months from the commencement of that apprenticeship, and then $4,000 at the completion of the apprenticeship. Apprentices will actually end up getting $2,000 as well, basically part at the beginning and then part at the completion. Now, the only catch here is this is only for certain apprenticeships. So the categories or the occupations will be reviewed each year, but at the moment we've got carpenters, plumbers, hairdressers, air conditioning mechanics, bricklayers, plasterers, bakers, vehicle painters, wall and floor tilers and arborists. Say that one quick.
So that's actually also good news. So we're getting money for the employers and money for people looking to get into those industries. So it's actually a win-win on both sides of that.
It'll be great, and it'll be fantastic to see that kind of expanded to more industries, because obviously employers put a lot of hard work and time and effort into apprentices, and we need those apprentices to keep a lot of those trades going. So there are a couple of other things. EMDG, we love a good acronym as accountants. EMDG is the Export Market Development Grant, and it's probably the only thing that was really geared towards startup communities in last night's budget. So there's a 60 million increase in the actual funding for the Export Market Development Grant. And for those who don't know what that is, it's basically a grant that says you are eligible to claim 50% of your marketing activities that are specifically related to you exporting your product or services. And what currently happens now is you need to spend a minimum of $15,000, but you can actually get a grant of up to $150,000. Now, the first $40,000 that you're able to actually get, the dog's really excited about that. Welcome to our newest employee. His name is Boss. He loves the Export Market Development Grant. I think he can probably work out a few things that he would like to export. So the grant up to $150,000, you get the first $40,000 when you actually do the application of the grant, and then the remainder that you spend, you actually get a portion of that based on a pool of funds that the government has available. So this extra $60 million means that more people will be eligible for some of that actual grant that will be available. No changes to R&D though, which is possibly a good thing at this present point in time. And as I said, that's really the only thing for startups.
What about the dodgy people? The people that are avoiding the tax that the government always wants to start catching?
So there is a lot of funds that have been given to the government to really, really crack down on, as we call it, the dodgy people. So if you're doing everything right from a tax perspective, then you are definitely not in the ATO's sights. So the ATO have $1 billion to scrutinise tax avoidance schemes and strategies. Wow. So this is over 4 years, not this year, thankfully. But the expectation is that this will actually collect $3.6 billion in tax. And really they're targeting multinationals, large public and private groups, as well as high net worth individuals. On top of this, and still targeted to those same people, is another $42 million that's really designed to cover unpaid tax and unpaid super. So making sure that big employees, multinationals, are still paying everybody super, as they should be. Something to note that is probably going to impact small business is an extra $9.2 million to the Fair Work Ombudsman. And so what's happening from that perspective is it's all about sham contracting. So for those people who are continuously having the same contractors work for them all the time, that realistically is an employee relationship. And Fair Work will be cracking down to ensure that those people are paying workers' comp, that they're paying superannuation, and also those employee entitlements like annual leave, etc.
That's great.
So the other big thing is the government agencies are actually getting a lot more information from the ATO. So this is actually going to mean that data matching will be fantastic and phenomenal, in that the ATO will have so much information that they don't currently have now, which will make the income tax return process easier, but also ensure everyone is paying their fair share of tax.
So Steph, tell us what's happening with strengthening of the ABN system.
So there's a lot of people in Australia who actually have an ABN, and from 1 July 2021, so it's not happening right now, the ATO are implementing a new strengthening the ABN system. And so what that's going to mean is anyone who hasn't lodged a tax return, who has an ABN, is basically not going to be allowed to have an ABN anymore. So if you're one of those good people and you're running a business and you're lodging your income tax returns, then the only change will be that you need to confirm the accuracy of your actual ABN details, and we assume that will be done just as part of the income tax return. However, for those people who have an ABN and who are invoicing people with an ABN, but they're not lodging an income tax return and reporting that income, will certainly be caught out, because those ABNs will effectively be cancelled, which again, Good news for those people doing the right thing.
Yep.
Bad news for those dodgy people.
Makes sense. Is there any other tax stuff happening that's worthy of note today?
So primary producers and farmers, tourism operators, have a bit more of a rebate for luxury car tax. So at the moment they get a $3,000 rebate for luxury car tax. That's increasing to $10,000, which is great certainly for the farmers who are buying the cars and stuff that they actually need. Those impacted by the Queensland floods and storms, the grant payments that the ATO have been giving will be tax-free, which again is fantastic for those who are impacted. And I guess the only other things to note that we were quite excited about for small business perspective is that there is now a $2 billion fund, or hopefully, if this gets passed, a $2 billion fund that's designed to help small banks and non-banks, so realistically not the big four, actually provide loans to small businesses. So we all know it's so difficult for small businesses to actually gain funding and finance. This will hopefully make that process so much simpler and also lower the rates. Very exciting. And the other thing to note is that there's a whole crackdown at the moment on the payment timeframes for both government and large businesses. So we know if you do work for a larger business, sometimes it can take you 90 days to actually get paid, which is crippling for small businesses. So the government is working really, really hard to actually reduce this down to 20-day payment terms instead of 90 days. So the government's trying to ensure that all small businesses who deal directly with the government will be paid in 20 days, and this is set to start from the 1st of July 2019. And for larger businesses with over $1 million in turnover, they will need to report their payment terms, and the ATO is trying to work with them to get that down to 20 days as well.
Excellent.
Very exciting.
Good cash flow for small business.
Good cash flow. So what's happening with individuals?
Everyone's got a tax break last night.
Yay!
Just remember, this is for people if Liberals stay in power. So if
I earn less than $37,000 in a year, what am I getting back as a tax offset?
Okay, less than $37,000, you're getting $255 back in your tax return.
And when do I get that?
When you lodge your tax return, not beforehand.
Okay, so this is not an extra amount of money in my pay packet each week. This will be a tax rebate at the end of the year.
That's right.
Awesome. What if I earn between $37,000 and $48,000 a year?
So that's between $255 and $1,000 back per taxpayer. So if you've got two people in your house earning a similar amount of income, that's per person.
Awesome. Now, if I earn between $48,000 and $90,000, I get the whole $1,080. Is that right?
You sure do.
Happy spending. And if I earn between $90,000 and $126,000,
you get somewhere between that 1,080 back to zero.
Okay, so if I earn 126, I'm effectively going to get zero.
That's right.
All right. So pretty much anyone who's earning more than 126,000 gets nothing.
Yeah, that's right.
Okay. And so obviously that comes into play for this financial year, but there's also set to be some changes to the tax rates from the 2024 tax year. Is that right as well?
Yes, that's right.
So we're a little bit far out to actually be too excited about those tax rates.
But it's part of that full government strategy of having the majority of Australians paying under 30% tax on their income.
Yeah, so once we get to 2026, I think it is from memory, we will all be paying a maximum of 30% income tax, which makes a huge difference. So we put a bit of a fun fact on our Facebook page last night, just in terms of if you earn 60 grand, 100 grand and 200 grand, what you would get back each year. We'll put a link to that so that everybody has that for them as well. Now there's one extra thing happening for some individuals, the energy assistance payment. What's that all about?
So people that have low incomes, the government's actually trying to help you pay those electricity bills that just seem to keep going up and up and up. So you can expect to receive payments from the government via Centrelink for that.
And that will happen before the 30th of June, $75 for singles and $125 for couples,
That's
which
right.
will go some way to actually helping. Now, normally we have a big section where you tell everybody about all the changes to superannuation. And basically, there's been very little about super in this budget? Walk us through the couple of things that are on the table.
Okay, so at the moment, if you are over 65, you can no longer contribute to superannuation unless you meet a works test. Now that works test is working 40 hours in a 30-day period. So basically working for a full week in a month when you make that contribution. If you don't do that and you're over 65, you can't currently contribute to superannuation. So what the government's trying to do with that is extend those age restrictions in line with the way they pay the age pension. So the age pension is being increased to age 67, so therefore they're actually increasing that works test exemption up to age 67 as well. So if you're 65, 66 or 67, you can still make those concessional contributions and non-concessionals up until that age.
Which is fantastic because we're all going to be working till we're at least 67 anyway, aren't we?
At least.
Maybe 70. So what's happening with the non-concessional contributions and being able to bring those forward?
Yeah, so at the moment, if you're under the age 65, you can bring forward another 2 years worth of non-concessional contributions and make that contribution in one lump sum. So that's $300,000. Now, because the rules around contributing have been extended to age 67, those bring forward restrictions have been increased to age 67 as well. So let's just throw an example out there that if you're 65 and you might have inherited some money or sold a house, you can say, I've got $300,000 that I want to put into superannuation. You can do that without working if you're 65 and make that contribution into super that you'll obviously then live off in retirement.
And so this is just designed realistically for people to be able to get more money into superannuation.
That's right. So at the moment, the government's trying to actually protect superannuation industry in Australia, which is valued at $2.6 trillion. So it is a massive asset that they do not want to harm in any way.
Just a small amount.
Small amount.
Now, what happens if I want to contribute for my spouse?
Okay, so they've actually made additional allowances for people who are continuing that working period in their life past age 65. So you can now make a contribution on behalf of your spouse up to the age of 74, as long as after the age of 70 you meet that works test that we talked about.
So that 40 hours in that 30-day period.
That's exactly right.
Excellent. Now, any other changes to superannuation at all?
Not changes. So one of the big things people have been really worried about with the potential of Labor taking power, and Bill Shorten talking about it at every opportunity he gets, is the removal of these refund of franking credits. So quite a lot of our clients are now retired and in pension phase. Now that means that earnings inside superannuation are tax-free. So if you're investing in companies that pay dividends, you can actually get that refunded when your super fund lodges the tax return. And that actually really helps a lot of our clients with the funding of the actual pension payments. So you might get over the course of 12 months $50,000 of income that obviously you spend as part of your living arrangements. But on top of that, when we lodge your tax return, you could get $15,000 worth of franking credits. That $15,000 can pay for the fees to keep your fund open, as well as additional money that you might need for medication or for a new car or some home improvements. And that's actually part of people's funding strategy. So as it stands right now, no changes to that, which is really good news.
So a lot of these things we'll need to keep a very close eye on just in relation to some changes that might end up happening as well. But good news that at the moment, as part of last night, no changes, which is fantastic.
It is good.
Now, there's been a bucket load of spending announcements for the year, a lot for farming and agriculture, which is fantastic, a lot from an infrastructure perspective, which again is really, really good. One point to note with the infrastructure expenditure is the ATO is actually starting to crack down on who they'll do government and contracts and tenders with. So in order to be able to win a tender, you're going to need to have to make sure that your ATO obligations are up to date. So again, it's just another one of those things that are really trying to crack down on people who aren't paying their tax. There's been some additional spending in aged care and healthcare, as you would expect, but really excited about some of the farming and infrastructure things that are coming along. Now, there's one thing to note though. Last year, when we were doing our budget update, there were quite a few things that still haven't passed legislation. So we talked about them last year. Some of them were supposed to start this year.
We might be talking about them next year.
And they still haven't passed. So a couple of things that have passed: personal income tax cuts, and obviously we're getting more of that additional on top of what was announced last year, last night. Some more reporting requirements, so more people are going to need to lodge taxable payment summary reports that we went through, some more industries, that's all gone through legislation. And probably the big thing that is a hot topic certainly now is single touch payroll. Huge. So as of the 1st of July 2019, everyone who employs someone will need to report to the government every payroll what you have actually paid in wages, what you should have withheld in tax, and how much you should have paid in superannuation. And this is really designed so that the ATO have a snapshot all the time of who is paying their tax liabilities and not, and will obviously give them a lot of ammunition to go after people who aren't paying superannuation for their employees. So that comes in 1st of July 2019 for all of our clients. That's actually not a big deal. It's one tiny little button in Xero that you'll press every single time you actually say add pay run. So not really a big deal. We'll be registering all of our clients in May and June just to make sure that we've got all or any bugs ironed out before this comes into play on the 1st of July.
Sure.
But again, not something to be too concerned about, other than the fact that the ATO is going to have all of this extra data all the time. If you're paying your super and you're paying your tax, nothing to be worried about. If you're not, obviously you need to be paying that.
That's right. And there's a few things, particularly on the superannuation side of things, that were announced but are not yet law. So one of the ones that we got asked quite a lot of questions after last year's budget was, if we're a good fund and we don't have any audit issues, do we only need to get our fund audited every 3 years now? That's still on the floor of Parliament and hasn't actually become law yet. So that's a wait and see what happens in the next couple of months. And also there was a talk of increasing the number of people that could be part of a super fund from 4 up to 6. That's in the same boat. So it's been drafted, but it hasn't passed. So at the moment, that's just talk.
And there were a couple of other very random things that we talked about last year. The celebrity tax. You and I still aren't celebrities, so we don't personally have to worry about that one. But this was basically looking at taxing celebrities in their personal names as opposed to being able to put that personal services or personal celebrity income inside a trust or a company. That is still in Parliament, hasn't gone anywhere, so potentially may not go anywhere. There was a lot of discussion about Division 7A, which is basically when you have loaned yourself money from your company or from your trust that you haven't yet paid tax on. So there's been a ton of consultation papers circulating about that. The aim was to make it simpler. It's still sitting with Parliament, so nothing has yet happened with those rules to make anything simple. So status quo with that. And there was also one last year about cash payments more than $10,000. So as part of the ATO really cracking down on the black economy and trying to ensure that everyone is paying that tax, no one was going to be able to accept any payments if they were in cash and that amount was more than $10,000. So again, that's still sitting with Parliament right now, but expect that something along those lines is definitely going to pass given all of the extra ATO task forces and etc. that are actually happening now.
That's right. So lots of things announced but not yet law, and more proposals from last night. I think the easiest way to keep abreast of this is to actually keep up to date with Growthwise. We post regularly on Facebook and Twitter. We've got our Ninja News that you can subscribe to if you go to our website, and we'll keep you posted on what actually becomes law. And
we may be doing another one of these wonderful little budget updates, depending on who's in power. So we'll definitely keep you up to date on what's been passed as law and what hasn't. But realistically now, the big ticket items for you to be thinking about is instant asset write-off. But remember, this is no, please go out and spend money. It's only if you need it. And is basically just simplifying that deduction or that claim for tax. The income tax rates is a big one. Everybody will be getting a tax offset.
That's right.
Company tax rates obviously starting to reduce down. By the time we get to 2022, they're going to be 25%, but for the next financial year, still at 27.5%, unless you're over $50 million, and then you're still at 30%. And then obviously all of the superannuation that we've been through in terms of those changes to 66 and 65-year-olds, which will be great.
Exciting.
So we'll keep you updated. Any questions, head on over to our Facebook. We will be able to answer any of those questions. There was quite a fair bit of banter going on last night with people wanting to learn about all of these wonderful things. And for those of you who didn't quite look at our page yesterday for the pre-budget day, we put together a brilliant little playlist, which is very entertaining on all things money. So if you do need some entertainment in your day, we've got everything from Pink Floyd all the way through to Lil Dicky the Rapper. It was lots of fun before our federal budget and having to dive into those lovely little papers that we read all night.
It's good.
For now,
That's it.
bye.
Bye.